From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Federal regulators intervened to rescue depositors at Silicon Valley Bank and to try to stop contagion from the bank failure to the rest of the banking system. President Biden says it's not a bailout, and he blames President Trump for any troubles at the banks. We'll try to sort the fact from the political fiction and tell you where this latest financial panic could go. Welcome. I'm Paul Gigot, editor of the editorial page of the Wall Street Journal, and I'm here with two of my colleagues who follow these issues intimately, Alicia Finley and Joe Sternberg. Welcome to you both. So the backdrop here is Silicon Valley Bank with a couple of $100 billion in assets, was taken over by the Federal Deposit Insurance Corporation on Friday, and the FDIC was hunting for a buyer, held an auction on Sunday. Apparently, there were bids, but in the end, nobody, the FDIC, was willing to accept the bids. So no buyer yet for the bank and its assets, which is typically what happens in bank closures. You have the FDIC find a private buyer, private capital. But then on Sunday evening at about 6:20, I might add, about 8 minutes before my deadline, or the early edition, intervened with a statement, Fed, Treasury, and the FDIC, a joint statement saying that they'd insure the uninsured deposits at SVB and Signature Bank in New York, which was also closed by regulators. Plus, the Federal Reserve created a new lending facility, which we will elaborate on in a little bit. Let's listen to President Biden on Monday morning talking about what happened.
The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. There are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law.
Well, there you go. Joe Biden saying, we'll tell you what happened sometime later. Alicia, what do you think happened at SVB?
Well, I think at root, this was poor mismanagement of interest rate risk. So what happened was during the pandemic, the Fed essentially flooded the system with liquidity. A lot of that money went into venture capital funds and startup funds and deposits at the Silicon Valley Bank. The problem is the Silicon Valley Bank really couldn't lend that out safely. I think the deposits doubled in just a year. So what it did was it took on a lot of interest rate risk. It went heavily into treasuries, longer yielding or dated treasuries, and mortgage-backed securities. And these were yielding partly because of the Fed policies, they encouraging, pushing investors to take more risks and seeking higher yields when interest rates were essentially negative on a real basis. So it piled into longer dated fixed income assets while it was borrowing essentially short term. So this created essentially a duration risk. And as interest rates started rising, the value of the bonds, the assets fell. And as a result, as tech companies essentially and venture capital companies started to draw down their deposits, partly they were burning cash, and then, the rising interest rates put a lot of pressure on these companies. The Silicon Valley Bank had to liquidate its bond portfolio, but it was taking a loss. I think last week it reported it took $2.25 billion loss as it was selling its bonds.
And let me just intervene here for a quick second, Alicia. The reason it had losses was because when interest rates rise very fast on bonds, if you bought a bond at one value at, say, 1% interest rates, and then the interest rates go up to 4 or 5%, that bond loses value unless it's held until maturity.
Right. One question, I guess, is they didn't have to write down losses because they were purportedly holding a lot of these bonds to maturity, but then they really couldn't because they had to liquidate them to compensate for depositors. And so when these problems became clear last week, when it announced, Silicon Valley Bank announced that it would have to raise equity, that caused essentially a bank run, and depositors, VC companies and startups rushed to get their money out. And essentially Silicon Valley Bank was then insolvent.
Right. So combination of management mistakes at the bank, a failure at risk management, and regulatory mistakes and incentives, Joe. The monetary policy, loose monetary policy, flooding the financial system with cash. That cash had to find somewhere to go. Zero interest rate policy that got the banks looking for higher returns, higher yield than they could make. So they pushed into these fixed income assets. And then the rapid change by the Fed in its policy to counter inflation caught the banks in a difficult circumstance with the losses that they could have held to maturity if they didn't have to redeem them for depositors. So the fear now is contagion, that famous word where the Biden administration is worried that the other banks could be at risk. Bank stocks have taken a big hit in the last few days, particularly regional banks. And so they intervened to ensure the uninsured deposits at SVB and at another bank, Signature Bank in New York, which they also closed. Typically, under the law, banks' deposits are only insured up to $250,000. But now the FDIC is going to insure all uninsured deposits at that bank. That certainly makes a lot of people in Silicon Valley feel a lot better. Does it make you feel a lot better?
What a mess, Paul. I mean, this is really extraordinary, and there is so much to unpack about what's going on here. I mean, I think really the place to start in terms of understanding any of this is this purported fear that the Fed and other government officials say they feel about contagion risk, because that already is a huge failure of the post 2008 regulatory regime if we're even having that conversation. Because remember, the whole thrust of the banking rules that were very onerous, very expensive to comply with, and have had a big, if often hidden effect on the economy since then. I mean, the thrust was twofold. One was to try to ensure the security of individual institutions. And then the other was to manage the risk of contagion. And apparently, we are discovering that we're at the point where we can't trust this very regulated financial system can handle a run on something like the 16th largest bank, whose customer base is concentrated in one industry of startups in one region of the country.
That's a really critical point, Joe. This is not JP Morgan Chase. This is the 16th largest bank. Yeah, it had a couple hundred billion in assets, but they should have been able to, number one, manage that risk and monitor it from a regulatory point of view. But why is one bank failure like this a systemic risk, which is what the FDIC apparently triggered? It's a so-called systemic risk exception.
What probably has spooked regulators is the prospect of a bank run, which is a fairly unusual development in an advanced economy like the US, and is exactly the phenomenon that deposit insurance is supposed to prevent. But then again, I mean, a unique feature of Silicon Valley Bank is that such an enormous proportion of its deposit accounts were too large to be covered by FDIC insurance, which caps out at $250,000. So already I'm having a lot of trouble figuring out how many banks would actually be in similar danger of a run, because most of them have a much larger proportion of their deposit base doesn't need to run on the bank because they already have that insurance. But I do think that what is also probably making regulators and especially the Federal Reserve very nervous is a different kind of contagion. You know, not necessarily the fear that a run on Silicon Valley Bank or any other institution would trigger a cascading series of disasters as that spread throughout the financial system, but the reality that they are all exposed in one form or another to interest rate risk as we are exiting this reckless, unprecedented period of about 15 years, ahistorically low interest rates. And never in world economic history run an experiment like this where you have policies of that sort for 15 years and then try to come out of them. And if I were the Fed, I would probably be nervous about where the vulnerabilities are going to start showing up.
On that front, the Fed created a new, essentially, facility that's called Special Purpose Vehicle, in which the Federal Reserve will offer loans to banks for up to 1 year against the collateral of those treasury bonds Alicia mentioned and those mortgage-backed securities she mentioned. And that is essentially a kind of expanded liquidity vehicle so that the banks can ride out, in essence, this period of losses on their bond investments not have to take the markdowns and transfer the risk from their own balance sheets onto the Federal Reserve. It's rather extraordinary that they would do this, but I think, Alicia, this is their attempt to try to stop potential contagion.
I think that's right. I think they were already seeing other, potential contagion this week with stock prices, the big banks, plunging because there has been a rush to get deposits out of a lot of these regional banks because concerns that this interest rate risk, even though it's not just isolated to the Silicon Valley Bank, that it is a much broader problem in the banking system and among these mid-sized regional banks. Perhaps it's, more acute to add those like PacWest and others that were on the West Coast, where you do have more concentrated base in the tech community or biotech community. But I think the purpose of this facility was to essentially calm down markets, assure depositors that their money will be available. The Fed is essentially backstopping these banks with this lending facility. I was told a lot of the small sized banks have basically already been tapped out the discount window.
The Fed's normal liquidity provision facility, which is the discount window.
Right. So hence the need to establish this extraordinary facility to provide, I think it's backed up by about 25 billion. To me, that seems like it might not be enough, but perhaps, as the Fed says, we don't anticipate that we're going to actually have to use all that $25 billion in terms of making loans or buying back the mortgage-backed securities and treasuries at par. It's essentially just intended to calm markets. And I don't know if that's actually been successful, judging by the volatility in the bank stocks, that some investors seem to believe that there's a lot more problems going on at some of these banks. 1-year loans, we don't know exactly how much the Fed will actually buy or lend against, again, from some of these banks will be enough to staunch the losses and prevent some of these banks from going insolvent.
That $25 billion provided by the Treasury Department's Exchange Stabilization Fund, which typically backstops these Fed facilities when they are created.